Know this: the account is frozen. Not emptied, not seized. Frozen. The moment a bank is notified that an account holder has died, it stops. No withdrawals, no transfers, no access. The direct debits that were running the mortgage, the utilities, the insurance stop being honored. The money is there. It simply cannot be touched. Most families find this out the hard way. Someone tries to pay a bill. The card declines. They call the bank. A representative named Carla explains, with measured patience, that the account has been flagged as belonging to a deceased individual and access requires a court order or proof of legal authority. They do not have a court order. They do not know what legal authority means in this context. This is the first hour of what is about to become a very long process. Here is what actually happens when someone dies without a will. Not the version people imagine. Not the version that ends with the government taking everything. The version that actually unfolds, in sequence, for the family left behind. The specifics vary by state and country. The mechanism is the same everywhere. When you die without a will, you die intestate. That word intestate is the legal term for dying without written instructions. It triggers a process called probate. Probate is a court-supervised procedure that identifies your assets, pays your debts, and distributes what remains to your heirs. It is public. It is slow. It is expensive. And it is entirely avoidable. The probate filing costs money before it recovers any. An attorney retainer of $2,500 to $5,000 is standard before the process begins. Court filing fees, executor fees, appraiser fees for real property. In most states, the total cost of probate runs between 3% and 7% of the gross estate value. On a $400,000 estate, that is up to $28,000 paid out of the estate before a single heir receives a dollar. The timeline: 6 months minimum. 18 months is common. 2 years is not unusual for contested estates or real property. The family waits. The mortgage still comes due. The utilities still run. The bills arrive addressed to a person who is no longer here to pay them. And the account that could cover all of it is frozen, sitting in a bank, waiting for a court to tell it what to do. The bank doesn't take your money when you die without a will. The court takes your time. And time, as it turns out, has a price. The state already has a plan for your money. It has always had a plan. You just didn't know you were relying on it. Every state in the country has intestate succession laws, a predetermined hierarchy that determines who inherits your assets when you leave no written instructions. These laws were not written for your family. They were written for the statistical average family. They apply to your family anyway. The hierarchy looks like this. If you are married with children, your spouse and children share the estate, in proportions that vary by state. In many states, your spouse does not automatically receive everything. Your children, including minor children who may require court-appointed guardians to manage their inheritance, may receive a significant portion. If you are unmarried with children, your children inherit everything, split equally. The partner you lived with for 11 years, who shared your mortgage, who you intended to provide for, inherits nothing. The law does not recognize intention. It recognizes relationship categories. If you are single with no children, your parents inherit. If your parents are deceased, your siblings. If your siblings are deceased, their children. If none of the above, the state may ultimately claim the estate through a process called escheatment. An estate attorney named Marsh, who has handled intestate cases for 22 years, puts it plainly. Most people assume the law will figure out what they would have wanted. It won't. It will figure out what the average person in their situation probably wanted. Those are rarely the same thing. The estranged sibling who hasn't spoken to you in 14 years inherits the same share as the one who was at your bedside. The partner you've been with for a decade inherits nothing if you're not married. The friend you told, in an afternoon conversation 3 years ago, that you wanted them to have the house inherits nothing. That conversation was not a will. It was a statement of intention. Intentions are not instructions. Intestate succession was written for the average family. It will be applied to yours regardless. The only way to override the default is to write a different plan before you need one. The house is the most dangerous asset. Not because it is the largest, because it is the least liquid and the most emotionally loaded. and the law treats it as neither of those things. It treats it as an asset to be divided. Consider this scenario. A woman dies at 58. She owns a home jointly with her partner of 9 years. They are not married. The home is worth $340,000. She has 2 adult children from her first marriage. Under intestate succession in most states, her partner has no legal claim to the property. Her 2 children inherit her half. The partner who shared the mortgage, who painted the kitchen, who has lived there for 9 years, is now a co-owner with 2 people who may not want to hold the asset. The children have 3 options. Buy out the partner's share of their mother's half, sell the property and split the proceeds, or allow the partner to continue living there, paying rent in the house they helped build. The children choose option 2. The home is listed. It sells in 6 weeks. The partner of 9 years has 60 days to vacate. No one in this scenario wanted this outcome. The woman who died did not want this outcome. She had told her partner the house would be theirs. She had meant it. She had not written it. Real property that passes through probate becomes a public record. Every creditor, every estranged relative, every party with a potential claim can see it. The process of determining what happens to a jointly owned property can take 12 to 18 months, during which time no party can sell, refinance, or use the property as collateral without court approval. If your estate includes real property and you die without a will, the house does not automatically go to the person you would have chosen. It goes to the hierarchy. And the hierarchy does not know your life. The form from 2009. Here is the most important thing most people don't know about what happens to their money when they die. Some of it will never see a probate court, not because it's protected by a will, because of a form. Certain assets pass outside of your estate entirely. They transfer directly to a named individual, bypassing probate, bypassing the intestate hierarchy, bypassing any will you may or may not have written, based solely on a beneficiary designation form that you filled out at some point and have possibly not thought about since. These assets include life insurance policies, 401 CAC accounts, IRAs, 403 B plans, many brokerage accounts with a TOD transfer on death designation, bank accounts with a POD payable on death designation. When you die, these assets go to whoever is named on the form. Immediately, without court involvement. If the named beneficiary is your current spouse, straightforward. If the named beneficiary is your ex-spouse from a marriage that ended 11 years ago, also straightforward. They receive the asset. Your current spouse does not. Your will, if you have one, cannot override a beneficiary designation. The form outranks the document. A man named Derek, his estate attorney, tells this story with the flat precision of someone who has repeated it 50 times, died at 61 with a $480,000 401 CAC. His beneficiary form, last updated in 2009, named his ex-wife. They had divorced in 2014. He had remarried in 2017. His current wife received nothing from the 401 cook. His ex-wife, with whom he had had no contact in 7 years, received $480,000 within 60 days of the death certificate being filed. His will, had he written one, would not have changed this. The only thing that would have changed it was updating the form. If a beneficiary designation field is blank, which is more common than any financial institution will tell you, the asset falls into the estate and enters probate. The same asset, the same account. 2 completely different outcomes depending on whether a field was filled in. The beneficiary designation on a form from 2009 outranks a will signed in 2024. Check the forms, all of them, today. The business dies with you. Not immediately. But the clock starts the moment you do. A business without a succession plan and without a will enters probate as an asset. The court oversees it. No significant decisions can be made without court approval. No new contracts. No asset sales. No distributions to partners. In industries where relationships and active management determine value, consulting, professional services, construction, healthcare, the delay alone destroys what it was meant to protect. A business with 3 partners. One dies without a will and without a buy-sell agreement. The deceased partner's share of the business valued at $1.4 million enters his estate. His estate enters probate. The two surviving partners now share ownership of the business with the probate court, and eventually, with whoever inherits the deceased partner's share under intestate succession. That may be a spouse who has no interest in the business. It may be adult children who disagree with each other about what to do with it. It may be someone with no business background, no relationship with the clients, and no ability to contribute to operations who nonetheless holds a legal ownership stake and must consent to any significant decision. The business continues to operate during this period. Sort of. The surviving partners continue to show up. They cannot bring in new investors. They cannot refinance the operating line. The key client, who was the deceased partner's relationship, calls to ask what is happening, and nobody has a clean answer yet. 6 months in, that client has moved to a competitor. The $1.4 million stake, by the time the estate is resolved, is worth something less. How much less depends on how long the process takes and how many clients made the same call. A business with no succession plan is not an asset at the moment of death. It is a liability with a deadline. A buy-sell agreement funded by life insurance, drafted in advance, would have transferred the deceased partner's share to the surviving partners for a predetermined price within 30 days of death. The estate would have received cash. The partners would have retained control. The client would have received continuity. One document, written before anyone needed it. 5 chapters, one through line. The frozen account, the hierarchy that doesn't know your life, the house that goes to the wrong person, the form from 2009, the business that loses a client while the court decides who owns it. None of these outcomes required malice. None required negligence. None required a complicated estate. They required one thing: the absence of a document. But here is what almost nobody explains about why most people never write the document. It is not because they don't care about their families. It is not because they don't understand money. It is not even because they believe they have time. It is because they believe something specific about who wills are for. Stay with us for 90 seconds. Most people believe wills are for the wealthy, for people with complicated estates, for people with assets worth protecting, for people who have something to lose. They are wrong. A will is not a wealth management tool. It is a communication tool. It is the only legally binding instruction you can leave for the people who will be managing the worst moment of their lives while simultaneously trying to figure out what to do with yours. The wealthy do not write wills because they have lawyers. They have lawyers because they understood, at some point, that the state has a default plan for every estate, regardless of size. And the default plan was written for the statistical average, not for their family. Most people think dying without a will means the government takes their money. It doesn't. The government takes their intentions. The money goes where the law says it goes, and the law says it goes to a hierarchy. The hierarchy may align with what the person would have chosen. It may not. The law has no mechanism for knowing the difference. The estranged sibling, the ex-spouse on a form, the partner of 9 years who painted the kitchen, the child from a first marriage who was supposed to receive less. The parent, the deceased, had complicated reasons to exclude. The law sees none of this. It sees a hierarchy. It applies it. A will does not require a lawyer, though a lawyer helps. It does not require significant assets, though every level of wealth benefits from one. It does not require certainty about who gets what. It can be updated, changed, and revoked at any time before it is needed. It requires one thing: the willingness to have a conversation with the future on behalf of the people you will leave behind. Most people never have it, not because they don't love the people who will be left, because they believe there is more time than there is. A will is not a document about death. It is a document about what you wanted to happen after it. The only version that counts is the one you wrote before you needed it.